Imagine owning a piece of prime real estate, like bustling malls, high-rise offices, or luxury apartments, without dealing with tenants, repairs, or massive down payments. Sounds too good to be true. Welcome to REITs, or Real Estate Investment Trusts. In this ultimate 2025 guide, I'll break down exactly what a REIT is, how it works, the pros and cons, and how you can start investing today for passive income. A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing real estate. Think of it like a mutual fund for properties. You buy shares, and the REIT pools money from investors to buy and manage assets. REITs were created by the U.S. Congress in 1960 to make real estate investing accessible to everyday people, not just the ultra-wealthy. Fast forward to 2025, and the global REIT market is booming at over $2 trillion, with strong growth in the US, India, and Europe. In India alone, REITs like Embassy Office Parks have grown multifold since 2019, driven by post-pandemic demand for commercial spaces and e-commerce warehousing. Here's the magic: REITs must follow strict rules. By law, they have to invest at least 75% of assets in real estate and derive 75% of income from rents. REITs are required to distribute at least 90% of their taxable income as dividends to shareholders. That's why they're famous for steady passive income. Yields often range from 4 to 8% in 2025, beating many savings accounts. If you invest $1,000 in a REIT yielding 7%, you could earn $70 a year in dividends, paid quarterly or monthly. The REIT handles everything: collecting rent, maintenance, and even expansions. Your job? Just collect the checks and watch for capital growth as property values rise. Not all REITs are the same. There are three main types. First, equity REITs. These own and operate properties like offices, apartments, malls, or warehouses. They make money from rent and property sales. Second, mortgage REITs. These lend money for real estate, like mortgages, and earn from interest. They're more sensitive to interest rates but can offer higher yields, like AGNC investment at 10 to 12%. Third, hybrid REITs, a mix of both, balancing income from rents and loans. Why choose REITs? They're liquid. You can buy or sell anytime. They're diversified, spreading risk across many properties. And they pay steady income, thanks to those 90% dividends. REITs aren't risk-free. Rising interest rates can cut dividends, market downturns can drop share prices, and unusually high yields may signal trouble. Some experts, like Ben Felix, say REITs aren't unique and carry extra risk. Still, in 2025 they've proven resilient, offering inflation protection and diversification. Always research, look at dividends, occupancy, and management, and keep REITs to just 5 to 15% of your portfolio.